In this video, I want to talk about the long straddle strategy. And this is really one of my favorite strategies because it does not rely on picking a market direction. So it's a market neutral strategy, and you use it if you think that a stock is going to make a big move. But maybe you can't decide whether it's going to go way up or way down. Maybe a stock like Tesla, which seems to always go way up or way down. A long straddle might be the perfect position. Now, what is a long straddle? Well, you buy a long call and you buy a long put. You buy a call and you buy a put at the same strike price, and it's usually at the money. So as close to at the money as you can get if you can't get exactly at the money. So let's say your stock is trading at 50. In that case, if you want to put on a straddle, you'll buy a 50 strike call, and a 50 strike put. Same stock, same expiration. And this position will make money. The main way that it makes money is if the stock makes a big move up or down. And as we'll see, you don't have to buy the call separately and the put separately. There are ways of entering the trade simultaneously, just like a spread trade where you simultaneously buy the call and buy the put. Now, what's nice about a long straddle? Well, if the stock moves up a lot, the straddle will enable you to get more and more long as the stock goes up. So what's going to happen if the stock moves up after you put on the straddle? That put's going to be losing value because the stock's moving up, obviously. But that call is going to be making more and more money as the stock moves up. And as we'll see when we look at the Greeks, as that call moves up, its delta is also going to increase. So as a result, the more the stock moves up, the more long this position gets, and the less short it gets because the put becomes more and more insignificant. Likewise, if the stock moves down a lot, you're going to get more and more short. The call is going to lose value. Eventually, it's going to be so far out of the money because the stock has fallen so far that the call is going to be sort of irrelevant. But that put is going to get a higher and higher delta. In other words, a more and more negative delta, closer to -1. And so as a result, as the stock continues to move down, you're going to get more and more short. So this is nice because it automatically positions you to get more long as the stock moves up and to get more short as the stock moves down. Now, because you're long a call and long a put, this position also makes money if the implied vol moves up. Because you're long a call, if you're long a call and implied volatility moves up, the call increases in value. Likewise for the put. And because of put-call parity, this is another reason that they both need to move up. Now, what's the maximum profit? Well, the maximum profit is really unlimited, simply because a stock can go way, way, way up. It could also go way, way down. It's sort of bounded at 0. But let's say you're putting it on at 100 or 150. That's where the stock price is, and you're doing an at-the-money straddle. Your max profit is essentially unlimited, especially on the call side because the stock could go way up. What's your max loss? This is another nice thing about long straddles. Your max loss is just going to be the debit paid, which is going to be the price of the call plus the price of the put, times 100. 100 shares, the typical multiplier. This is for each call and put. So you buy a call, you buy a put at the same time, and together those constitute a long straddle, and they'll have a certain debit associated with them, which is just the sum of the price of the call, the cost of the call, and the cost of the put. And we're going to do an example, so you'll see some numbers. Now, what's the maximum loss? Well, that maximum loss, again, is just that debit paid, that total dollar amount. But that's only going to happen if the stock expires right at that strike price. So what happens if you're long a call and you're long a put and the stock expires right at that strike price? In other words, it's pinned, as we would say, pinned at the strike price at expiration. Well, in that case, the call's going to expire worthless, the put's going to expire worthless, and as a result, the entire straddle is going to expire worthless, and you'll lose that entire debit that you paid. And again, you can always trade out of this before expiration. So this is assume you just hold it to expiration and the stock expires right at that strike price. Normally it will expire a little above or a little below, so you won't have that complete max loss. What is your upper break-even price? Well, it's just the strike price plus the debit paid. So the stock needs to go up. If you're doing it right at the money, the stock needs to go up enough to compensate you for the cost of that debit. Likewise, the lower break-even price, the stock has to go down enough past the strike price to make you money. This will make a little more sense when we see real numbers associated with it. Now, what happens if you hold a straddle into expiration? Well, two things can happen. Well, actually, three things can happen. The first one we already talked about. If the stock expires If the options expire when the stock price is right at that strike price, the straddle will expire worthless. Nothing will happen. If the call is in the money at expiration, you're going to end up being long 100 shares right at that strike price. If the stock moves down and instead that long put is in the money at expiration, you're going to end up short 100 shares at the strike price if you hold it into expiration and that long put expires in the money. Now again, there's usually no reason to hold a straddle into expiration. This would be very strange. Normally you want to put these on and take them off simply because there's time decay associated with them. And as we'll see when we look at the Greeks, there's actually double the normal theta decay or time decay because we're long a call and a put. So generally, you want to get into these, and then get out of them. And you certainly don't want to hold into expiration unless you have some real reason that you want to get long the stock or get short the stock. Now, people often ask me about assignment risk with long straddles. Again, there's no assignment risk simply because you only get assignment risk when you're short a call or short a put. In this case, we're long a call, we're long a put. We could choose to exercise them, which we probably won't, but there's no assignment risk because we're long the options. So here's an example that just happened overnight. Today is November 5th, 2019, and we're going to be looking at Shake Shack, S-H-A-K, one of my kids' favorite places to eat. So yesterday, yesterday on November 4th, the stock closed at 84.21. This was right before earnings, and then earnings were reported right after the bell, and earnings were negative. There was a very bad forward guidance and the stock gap down. But let's look at what happened right before that. So if we wanted to enter a straddle yesterday, right before the market closed, right before earnings were recorded, we could buy the 84 call. So there's no 84.21 call. We want to get as close to at the money as we can, but we'll use an 84 straddle, which is fine. So we'd buy the 84 call at 5.15. We'd buy the 84 put at 4.75. And together, if you add 5.15 plus 4.75, you get a 9.90 debit, $9.90. Multiply that by 100, and you'll see that this position, going long the straddle, cost us $990 for one straddle, as we would say. You could do 10 of these, in which case you'd be buying 10 calls and 10 puts, and it would just cost 10 times as much. It would cost $9,900. Now, what options did we use? In this case, I chose to use the options, the weekly options that expire just about 2 weeks out, roughly. Call it 18 days out. And I did this because they don't have a lot of time value left. You enter a long straddle going into earnings because you're expecting a big move. And so you don't want to pay for a lot of time value if you don't have to. So I could have chosen options that were a week out or a month out. Somewhere in there is a sweet spot. I chose these. Now you can, as I said, in both of these cases, you're going to be buying to open a call, buying to open a put, or as we'll see when we look at our brokerages, you can do it as a single transaction, as a single straddle transaction. Now, what's the max loss in this position? Well, it's just that $990 we paid for the combination of the put and the call. What's our upper break-even price? Well, if Shake Shack had a really good earnings, if the stock had moved up 9.9 above that strike price, so 84 plus 9.9, if it had moved up to 93.90, that would be kind of a break-even point, because at that point we would have exactly compensated for the cost of the straddle. The break-even price on the downside, which we'll see is how the stock moved, is just the strike price minus that debit, 84 minus 990, or 74.10. Now, what exactly happened? Well, yesterday the stock closed at 84.21, and as I'm recording this, the stock is now at 67.16. So if we go look at a price, a stock chart, you can see that earnings were very bad, or we can tell they're bad because the stock moved down. Well, it's moved a little bit since I took these samples, but the stock basically moved down 20%. It gapped down, this big overnight gap. So what kind of move was priced into Shake Shack before the earnings? Well, in order to see that, we can just take that closing price of the stock yesterday, right before earnings, and divide into it the price of the straddle, $990. So we can see that this is a little bit different than looking at the break-even prices. In those cases, in that case, we would add the debit to the strike price or subtract the debit from the strike price. Here is just a way of measuring what sort of move is being priced in. So going into Shake Shack's earnings yesterday, the market's best guesstimate of how much the stock would move, either up or down, was 11.76%. And that, again, is just the cost of the straddle, $9.90, divided by the closing price of the stock. So that kind of move was being priced in, an 11.76% move. So if you're going long a straddle, you have to believe that the stock is going to move more than 11.76% as a result of earnings. Now, as I'm recording this, the stock is at 67.16. So the stock actually moved a lot more than, it almost moved double that. It moved down 20.25%. So that's a much bigger move than the expected move that was being priced in. As a result, a long straddle made money in this case. Right now, day after earnings, November 5th, 2019, that call option, which we paid $5.15 for, is trading at just 8 cents. And that put option, which we paid $4.75 for, is now gone up quite a bit, as you would imagine, since the stock crashed. It's gone up to $16.70. So if we just add the current price of the call and the current price of the put, that is $16.70, price of the put, plus 8 cents, price of the call, we get $16.78. So in other words, the price of that straddle as a result of earnings moved from $9.90 to $16.78 for the price of that straddle. So if we'd done this trade, that's a return of 69.5%. Really nice money for an overnight trade. Again, when you do a straddle, though, you're risking 100% of the premium that you put into it. So keep that in mind. The risk reward of this trade is not perfect because you're risking possibly 100% to make 69%. But if you've been following Shake Shack, maybe you've been following the traffic at the restaurants and you think traffic is way down and the market's not pricing it in and it's really going to have a bad earnings report, this is a nice way of trading it. Now, how do you exit this? Well, you can just sell the straddle as a single transaction, which we'll see, or you can sell the call, sell to close the call, and sell to close the put, and just do them separately. But normally you would do it. You would enter as one transaction, you'd buy a straddle, you'd go long a straddle, and then you'd exit that straddle after earnings or after whatever move was made. So let's back up and we'll take a look at how to actually place these trades. So let's go to Robinhood first. We type in Shake Shack, S-H-A-K. We click Trade Shack Options. And so let's see how we would have put this on yesterday. We would have picked the November 22 call options. And again, the stock closed at about 84. So we're going to want to be looking right at the 84, the at the money calls. And so what we're going to do is we're going to buy a call that's at the money, the 84 call. And we're also going to buy a put, same expiration, November 22, buy a put that's at the money. So again, we'll buy the 84. Now you can see these numbers have moved around slightly since I did my my keynote presentation there. So today, right now, I think I said the straddle was trading at 1678. The market finally closed. It moved a little bit. It's trading at 1730. So again, these are the prices here that that the straddle is trading at right now. So I can't rewind this, unfortunately, to show you what it would have looked like yesterday. Robinhood doesn't allow that. But this is if I wanted to buy the straddle today, it would cost me $17.30. Now there'd be no reason to do this really today because this is the straddle is way out of the money. But you can see here, the only reason I'm doing this is to show you can input both of these as a straddle, and it tells you it's a straddle. And then you can just click continue, and you can use this limit order here, and Robinhood will ensure that this is the maximum that you pay for that straddle. And so you don't need to enter the call separately and the put separately. You can enter it as a single transaction. So again, if we were doing this today, maybe we'd go a little further out. Let's say we think the stock is going to make another big move over the next month. So today is November 5th. So let's say over the next month till December 6th, we're going to buy a call that's at the money. The stock's currently at 66.83. So we'll probably, we can use the 66.50 call option. Let's exit out of both of these. So we'll buy a call expiring December 6th. We'll buy a put expiring December 6th, also the 66.50. And you can see an at the money call option, I'm sorry, an at-the-money straddle right now, so the stock's at 66.83, that's where it closed today, and we're going to be buying the 66.50 straddle right at 6.30. So you can see that the cost of the straddle is way down now, especially if you take 6.30 divided by 66.83. It's going to be less, and the reason for this is because there's no real event coming out between now and December 6th. We've already had earnings. The stock's made a big move. But again, maybe we think they're going to report same-store sales. There's going to be some data point that's going to come out and make the stock make a big move. This is how we would put on the straddle today on Shake Shack. Now let's look how we would do it on Thinkorswim. So again, we go to the Trade tab. We just type in SHAK. I'm just going to, we can do the same one. We'll go to December 6th. Stock's currently 66.83. So we will look at the 66.50. So again, the December 6th, 2019 expiration. We're going to try to find right at the money. I'm going to go on the call side here, right at 66.50 is the strike price. I'm going to right click, and then I'm going to say buy a straddle. And what that will do then is it will pull up, looks like it's pulling up 10 contracts. I can lower this, so I just buy one contract. But this would basically be, you can see it costs roughly the same. What was it, 615, 630. There's a little bit of discrepancy there, but it's basically a similar debit, $6.15. So multiplying by 100, it would cost me $615 to enter this straddle. It would cost me $630 to do it on Robinhood. They may be just sort of embedding their commissions there. But this is basically how you would enter a straddle using Thinkorswim or using Robinhood. And again, in this case, we could just click confirm and send if we wanted to do this, or we could also right click and go to the Analyze Trade tab and really take a look at the break evens. But again, break evens are easy to calculate. We'll just look at the strike price, 66.50 plus the debit 615 and 66.50 minus the debit 615. So that's basically how to place the trade in Thinkorswim and in Robinhood. Now, what do the Greeks look like for a long straddle? Well, your initial delta, and this is kind of interesting, your initial delta, if you do it right at the money, the stock is right at that strike price of the call and the put, your initial delta is going to be 0, simply because an at-the-money call has a delta of roughly 0.5 or 50%, and an at-the-money put has an at-the-money delta of minus 0.5 or minus 50%. So you just add those up and you get the delta of the whole long straddle position, which is 0. In other words, this tells us what we already knew, that straddles have a market neutral bias. Now, if you don't buy the straddle completely at the money, it might have a slight bias to the long side or the short side. Not something to worry about a lot, especially if you're expecting a really big move. But technically done, an at the money straddle has an initial delta of 0. And then as the stock moves up, or as the stock moves down, that delta is going to increase or decrease. So you can see, for example, the gamma of a long straddle is positive, because when the stock goes up a lot, your long delta gets bigger. You get more and more long the stock, simply because the call gets more in the money and the put gets more out of the money. And then when the stock goes down, your negative delta, your deltas can get more and more negative. In other words, you get more and more short the stock. So as we would expect, a gamma positive position benefits from a big move in one direction or the other direction. Now, this position, as we mentioned, as we alluded to, is a position that's subject to a lot of time decay. So as we would expect, it has a negative theta. And you have twice as much time decay, which makes sense because you're long a call and you're long a put. So you'd have twice as much time decay as you would have just being long a call or long a put. And this is another reason it makes sense to put this on right before earnings and take it off right after earnings. You don't want to hold a straddle for too many days unless you're expecting a really big move over those days. And the longer you hold the straddle, the bigger the move is going to have to be to compensate for that time decay. Finally, a long straddle position is vega positive. Simply, and this makes sense because you're long a call, you're long a put. If implied volatility goes up, the value of options goes up, and so the value of both your long call and long put will increase in value. So this is another way of using straddles long straddles is to go long volatility. If you think implied volatility is going to move up, even if you don't think the stock's going to move a lot, you can make money from a long straddle. So those would be sort of the two use cases. Putting on a straddle before earnings to try to bet on a big move, or putting them on before some big event. You could put on a straddle on the S&P 500 right before non-farm payrolls or some economic number, or you could do it for a stock before they're reporting maybe same-store sales or earnings or something like that. But those are the two ways you make money from a long straddle. Either implied volatility moves up, or the more likely way, the more common way, you get a big move in the underlying stock. So as we alluded to, straddles work best if you transition from a low volatility regime, a low vol regime, to a high vol regime. And this can be caused by new information like an earnings announcement, or it can be caused by maybe the overall volatility of the market increasing, maybe the VIX moving up. So if we go back and look at how Shake Shack was trading before earnings, you can see we had this sideways, this nice sideways chop going into earnings. So the stock did sell off, and then it sort of entered a much more low vol regime. And so this is one way. This is, if the stock is really bouncing around, a straddle might just be too expensive. But it helps if you're kind of in a lower vol regime. And then out of this low vol regime, you get a big break to the upside or a big break to the downside. That's how a straddle makes money. As we said, you want to, because of the time decay involved, you want to close out a straddle right away if you get a quick big move. If you get a quick big move, you can close out the straddle for a profit. And if you're expecting the move to continue, you can always just enter, maybe you buy a put, an at-the-money put or an at-the-money call, and or you could even buy a new at-the-money straddle. But normally you want to get into a straddle and get out, because the time decay can hurt you. And also if the stock goes nowhere and you get low vol and implied vol drops, the value of the straddle is going to go down. And again, you don't want to hold it very long because of that theta decay, that time decay. We'll talk more about this in a later lecture, but the great thing about straddle is just a very nice way of playing outsized moves in earnings of a stock.